which has happened mainly coming from.
Good. Amit, thank you very much for being here.
Your
Pleasure
pleasure is all
speaking
mine.
to you. Let's start by talking a little bit about Valion Group. Can you
Yeah.
explain us what Valion Group does?
Okay, so we are, Gustavo, we are an investment management and an asset management company. From an investment management standpoint, we work with about 140 family offices all over the world, helping them invest in alternative asset classes. 10% of that portfolio comes to real estate, and that's where we operate in. It's been 20 years. We have run this company as a homegrown IPC. With family offices, it's more about investments and real estate portfolio management for them in NRIs in India. And then we have a prop tech division called as Prop Tech, which is Prop Care, which is an asset management company where we manage assets for the clients. That's what Valiant Group does.
Perfect. When you look at the market size for real estate in India, some figures say that's around $335 billion, and some say that by 2030 we will reach $1 trillion.
$1 trillion. That's correct.
What trends are driving such a strong growth?
So, Gustavo, see, there are some very key factors which are impacting the drive, pushing the drive northwards. One is, of course, the infrastructure growth. So, earlier, what used to happen is there is a rise in real estate growth, which is about 8 to 9% CAGR year on year happening. But the infrastructure was lagging behind. Infrastructure was always at 4 5%. Now, when I look at this, infrastructure has caught up to about 7%. We're looking at by 2030, in CAGR terms, infrastructure and real estate will go hand in hand. When that kind of balance happens, there is a fundamental, very strong growth for real estate which drives in. And it looks very, so to say, organic in nature. So one is that there is a serious level of interest from the political environment is very good. Everybody is very happy with the political environment. The infrastructure growth is number two, which is very good. There are regulators which have come in, which were earlier not there in India anymore. And so you have RERA after that. So many things happened, and the consumer is the king, all that. Fourth point is that a lot of corporatization has happened in the development field as well. You look at the developers earlier, I mean, 8 out of 10 developers were non-corporate. Like they were not operating as a corporation or a professional organization, so to say. When I started, this is back in 2007-8. Fast forward about 15 years, anybody who is non-corporate doesn't know how to run an organization and have disciplined across financial as well as the entire construction arena will not be able to survive this trend. So you have regulators, you have great political environment, you have the the infrastructure growth which is driving it. Fourth, there is a lot of foreign capital because of all these factors which are now eyeing India in a very serious manner. So last year it was of course about $11.4 billion which were invested in India, with three major countries, Singapore, US, and Canada, leading the pack. And of course, UAE is also now trying to look at India very seriously. But there's a huge comfort which foreign investors have now, institutional capital has now with India as a country. And because of now the infrastructure growth, they also know that this is a sustainable growth. It is not something which is very speculative in nature, and it will sustain happening.
When you speak to the family offices and try to understand what kind of projects they are looking for, is this related to a specific location, or it is a asset class they're looking for, or they're trying to find just opportunistic situations where they can really maximize results on their investments? How is the full thinking process behind the decision making that comes, before deploying capital?
So, Gustavo, what happened? Most of the family offices have wealth preservation as the key parameter for them whenever they look at investments in a new country, or even if they're Indian family offices, real estate is not their core business. I mean, they generate wealth through various companies they
Of
operate
course.
in. And when they look at investment as in an alternative asset class, which is real estate for them, they look at capital preservation to be the number one asset. They mostly hold on to tier one cities. So we're looking at top cities between Delhi, Bombay, Chennai, Bangalore, Hyderabad. These main six key cities to be the prime cities where they look at investments, mostly commercial, income generating assets. which is normally obviously the wish list is of course 10% plus IRR, but they're able to touch about 8.5% to be on the safe side on the commercial stable asset from that perspective. Second, there are certain family offices who are a little more where the newer generation is coming and they've taken the reins in hand and are looking at opportunistic opportunities where they're looking at higher returns rather than just having an income generating asset. I mean, those kind of family offices mostly also bring in capital in a very regulated platform where they say either I will invest in an AIF and that AIF will further invest or co-invest with the developer at the land stage, which basically this is one of the examples I'm giving you where the family office is very aggressive and has about $100 million parked in an AIF. Wow. And that family office is now investing across the 6 cities with various developers on a land stage level. Now that what happens is that they buy in equity, the AIF buy in equity into those companies, which to maximize the returns for the investors. When the project entire the value chain, they're able to take care of the entire value chain. It brings in the investment here.
If I'm investor now sitting at home or in my office watching this interview, and I'm considering analyzing the opportunities in India, what would be the top 2 mistakes I should avoid to be successful in deploying capital here in India in the real estate market?
One is choose your partners very wisely. Be only with the top tier 1, AAA category, highly organized, sanitized companies, which you should do a very thorough check before you enter India, because one wrong example brings the whole environment down, the country down, everything down. So you have to be very sure of. There are regulators which are doing their own set of checks, but as an investor, I think it's our foremost responsibility to just check who I should be a partner with, and then it entirely depends on my personal objective for investment, whether I'm looking at opportunity, I want to run the India story, make the maximum capital appreciation on my money, or I should be an investor. India is just another country for me where I should take exposure because India is the economy which is growing at the fastest. Real estate, of course, as you rightly said, it will be 1 trillion by 2030. We're looking at minimum 9 to 10% growth CAGR year on year, which is highest in the world, right? I mean, we're saying Europe, we understand Europe and UK, how the markets are there. We understand US now, which is still growing, but we see a future recession coming into US. So India story, and with the China now, with the sanctions and everything, I think India is at the forefront to attract capital. So next 5 years will be equivalent to last 25 years. So I think it will be a similar story.
So if I understand correctly, in your view, it's a mix of, in one hand, the world is in a very uncertain position with Europe.
That's correct.
In a complicated situation, the US and China question mark, Russia and Ukraine.
That's correct.
Everything's like this, and India has been doing a good job investing in infrastructure, consistent government, and that's the reason. So it's a mix of both, do you believe?
Yes, I totally agree with you. I think these 5 factors which are now favoring India, so to say, for attracting the foreign capital is something which I think it's also the China sanctions, which earlier was a big competition for foreign investors to look at investing. But here with now the consistent political environment, regulatory framework, we're looking at, regulators, RERA coming in, all of that. And we're looking at a lot of corporatization happening in the development arena. So to say, all the big business houses are now getting real estate as a serious business, which earlier was a business for 5 out of 10 people were just doing it, but not so sanitized. So I think all these factors put together, if you choose your partners rightly, if you choose the market rightly, because you need to be, obviously there is a lot of talk about tier 2 cities having a lot of upside potential. I think as an outside investor, if you're coming from outside India, you should not try tier 2 at the first go.
Of course.
You should maybe look at tier 1, very mature markets tier 1, so that you understand how the world works here, and do 1 or 2 developments and to see how the returns are, and then maybe look at more risky proposition like tier 2. Though they see this potential in tier 2 cities as well, but that's more for people who have already established spaces, who understand real estate very well here in India.
Amit, a final question. Let's talk about what could go wrong. When you look at the numbers, when you look at the perspective, it's quite positive. But sometimes things can go wrong.
That's correct.
We need to be prepared.
Yes.
You know, what could go wrong?
Yeah. Okay. So, what could go wrong? Okay. So, if you're hedging your capital, I think I always believed in the Japanese way of operating business in a different country. They always come small. I mean, they always look at taking small bets. I mean, if you look at the capital availability in Japan, it's the maximum in the world. But if you look at when they enter a new country, they're always very cautious. They
True.
test it,
That's true.
they test it again at a little more higher, and then they go all out. And when they go all out, they conquer it. But what could go wrong? I think very clearly you need to be choosing your partners. Again, I would say, I mean, get on with the best lawyers in the country, be with the best developers if you're co-investing into a project at an equity stage. Don't try to do all by yourself when you're the first one, when it's your first project. Try to co-partner. Maybe your returns will get compromised to a certain extent in the first project or first 2-3
Well,
projects.
Is a price you learn, right?
Yeah, absolutely. But I think it's the risk you would take for
Amit,
that. Yeah.
thank you very much. Enjoy our conversation.
Pleasure is all mine.
Thank you.
Thank you.
which has happened mainly coming from
Good.